Hello, folks. It is Sunday, October 22nd. It's about 3 o'clock in the afternoon on the East Coast of the United States. Hello, hope you're having a great weekend. In this video, I will be looking at Invesco's commodity ETF. And let me share my screen and we'll get started. So there we go. Invesco commodity ETF, more specifically, we'll be looking at this Invesco Optimum Yield Diversified Commodity Strategy No K1 ETF. Now, how's that for a mouthful? No K1 is making the point that there's no K1 form involved with this particular ETF, which is it's a tax form. Evidently, it's complicated, tends to come late, and so it might delay your overall filing because you're waiting on a K1 form. And so anyway, they're making the point here that this ETF does not involve a K1 form. Let's keep rolling. As I was looking at this, I was asked to look at this ETF, and I'm glad I did. It's been interesting. The first thing that came to mind as I started looking at the components of this ETF is that it is very well positioned for both inflation and a wartime economy. And so if you think that one or both of those conditions are likely a part of our future, then this might be an interesting ETF for you to look at. More than half of the ETF is in energy, about a quarter of it is in food, and then the remaining quarter is split fairly evenly between base metals and precious metals. And so nice mix of commodities for these two factors. We keep rolling. Okay, and so here we're looking at these are the components of the ETF. They're weighting within the ETF and then the category that they fall into. And so let's start with the biggest, almost 53% of the ETF is energy. We can see 27% or so is oil between West Texas crude and Brent crude. This is heating oil, so almost 11% heating oil, and then gasoline, 12%, natural gas, almost 3%. So more than half of the ETF weighted towards energy, which again, for inflation or conflict, particularly conflict in the Middle East. As I have said, it would not be surprising to me to see the Straits of Hormuz closed here in the next couple of weeks. And that would obviously have a dramatic effect on petroleum. And so anyway, petroleum right now is not a bad place to be invested, in my opinion. But let me caveat that with, I'm not an investment advisor. I'm not a financial advisor. I'm not providing financial advice. Consult with your investment advisor, your tax preparer, your mama, all that for legal caveats. I'm just sharing ideas. Educational purposes only, I think, is what most disclaimers say. Let's keep rolling here. So, and then the next largest weighting within this ETF is food. And so we can see here 23%. Wheat, corn, soybeans, and sugar. And so again, whether it's inflation or conflict, these commodities are not a bad place to be invested right now, in my opinion. Wheat obviously brings us into the Ukraine-Russia region of the world and anything that might happen out there. So anyway, food's not a bad place to be invested right now. And then the next weighting is base metals. So zinc, aluminum, copper, all of those are important metals in particular in a wartime economy where you might actually have to build things like tanks, 155 millimeter artillery shells, etc. And so anyway, not a bad place to have exposure in the commodities, and then 11% silver and gold, and so precious metals, obviously a good place to be. Whether we're talking inflation or conflict, precious metals reacts to both, or tends to react to both. So that was my first thought about this ETF. Good mix of commodities, given the current conditions in the world as I see them. Risks. This particular ETF is invested in futures contracts and swap contracts. So in my opinion, very high risk, both of these high risk strategies. And then for collateral, because they are investing in these vehicles, they are required by the regulatory agency to hold collateral against their positions in these markets. And so their collateral is in the form of U.S. Treasury bills. So that's 1 year and less in duration. Money market funds, short term again, and then exposure within the banking industry. And so at this particular time, with the collapse of fiat debt currencies and the collapse of debt instruments in general and globally, this is a high risk place to be, in my opinion. So not only are they using high risk investment strategies, they're holding their collateral in high risk assets, in my opinion. So anyway, a lot of risk. There are tax consequences that are important to understand and look into if you choose to invest in this ETF or any ETF. One of the surprising things about the precious metals backed ETFs is that they sell to cover the management fees of those metals backed ETFs. They occasionally sell the physical precious metals. Well, subsequent to that selling, they receive a tax bill, and they pass that tax bill on to the investors in the ETF. So there you are, invested in SLV, GLD. You think, hey, I've got exposure to the precious metals, and the next thing you know, you receive a tax bill from your ETF. And so anyway, important to look into the tax consequences of commodity ETFs before you invest. And then third-party risk, because in this particular ETF, we've got not only futures contracts, but swap contracts as well. So that involves third-party risk. The debt instruments involve third-party risk, and then exposure to the banking industry, obviously that's third-party risk. And so anyway, high risk ETF, that would be my overall summary. This is just answering the question, what is a swap contract? Well, it's a derivative. Basically, it's two parties swapping assets. And so you would assume that there's an equivalency between the two assets that are being swapped. But there's not really, depending on what the swap is, there's not really a market for swaps. And so it can be challenging to determine what is the value of a swap. And so anyway, again, high risk strategy when you start dealing with swaps. Costs of this ETF, the management fee, 0.59%, which, that's almost $6 per thousand per year. That's not atypical of ETFs or mutual funds, either one. and in particular, anything that involves active manage, which, this ETF has active management to deal with the contracts, the futures contracts and swap contracts. So anyway, 0.59% management fee, and then we have rollover costs. So understand that, for like right now, if we were invested in gold futures, we'd probably be buying the December futures contract. Well, as investors, we probably don't intend to take delivery of that physical gold. And so at some point, probably in November, we would roll that futures contract into the next forward month, which offhand is January, February, whatever month it is. But there's a cost involved in rolling those contracts. And so anyway, there are rollover costs involved in this ETF. I didn't dig deep enough to see how those costs affect the performance of the ETF. But anyway, be aware that there are rollover costs in this ETF, and then tax consequences, as I mentioned. And we'll look here in a couple of tabs. We'll talk a little bit more about tax consequences. Now, so let's look just kind of a high level. What is this ETF about? I've already mentioned that there's no K1 form. That's important. PDBC, that's the NASDAQ ticker. Actively managed. One of the high objectives is to provide long-term capital appreciation. And then this is down into their risk disclosure. And let me zoom in on this a little bit. So, because looking at these risk disclosures gives us a feel for what the ETF is up to. What are they doing as part of their investment strategies? So the fact that they're telling us about short selling and margin indicates that they do go short. So not only are they going long on these commodities, they're also going short. And so again, shorting, doesn't matter what you're shorting, stocks, commodity futures, swaps, whatever, shorting is a high risk strategy, subject to management risk. The managers might be bozos, most likely they're not, but with an actively managed ETF, obviously human error is a risk. Futures contracts involves a whole set of risks. Rolling futures contracts, I just spoke about. High portfolio turnover rate, and that speaks to or highlights the fact that because they are futures contracts, they will be continually rolling those contracts forward, and there are fees involved with that, costs involved. So you would certainly want to understand the costs involved with this ETF before investing. Counterparty risk, I mentioned. Swaps involve greater risk than direct investments. Yes, indeedy, they're derivatives. And as I mentioned, may be difficult to value. There are no regulated markets for trading swaps. And so determining what they are truly worth can be challenging, can result in gains or losses substantially greater than the amount invested, potential for unlimited loss. And of course, that's true with whether you're talking about swaps or futures contracts. That's always a risk, in particular if you're going short. And so again, high risk strategy, derivatives. And so again, we're talking about the swaps, less liquid potentially than traditional investments. And that's because, again, there is no fixed market for for trading swaps. Basically, you have to find somebody to take the other side of whatever contract it is you're trying to swap. And so again, bunch of disclosures there, high risk strategy. This is, again, we're still talking about PDBC. This is their portfolio. So look at what are they invested in, and I showed you that back in the table. So 50% energy, etc. So that's just showing us the components of the ETF and their weighting. There's the specific swaps. Oh, and notice this makes it clear. These are individual contracts. So each one of these is a specific swap contract. And they're showing it, there's not a lot of exposure, 0.23%, but they do have exposure to swaps. And actually that's encouraging to see. I'm emphasizing the risk in swap contracts, but it's a very small percentage of the overall portfolio. So not a lot of exposure to swap contracts. And so this is what they're using for collateral, because again, when you're trading in futures markets, swap markets, you have to put up collateral. And so they're doing that with these are 1 year or less US Treasury bills. This money market portfolio is short term. It's money markets and similar investments. Dollar. This is the basically bank. It's exposure to the banking industry. Notice that both of these are Invesco products, and so kind of incestuous that the Invesco ETF is investing in Invesco products, which, I guess you could argue that reduces third-party risk. Anyway, we won't go into that. This was a article that I wanted to look into at a high level, just some of the potential tax consequences of commodity ETFs in general. And it just happens that this article is talking specifically about the PDBC and its counterpart, DBC, which is another Invesco ETF. And so I'll include the link to this article in the description below the video, because it's relevant to this ETF in general. One of the things they started with, they were talking about pesky K1. And then also I found interesting, because of the investment strategy involved with PDBC, evidently it throws off a lot of money in the form of distributions. And so one of the things they're pointing out in this article is that PDBC as an investment makes more sense inside a tax-advantaged account than it does outside of a tax-advantaged account. And that's why this article also mentions DBC. In the next tab here, we'll look briefly at DBCs. Basically, it mirrors PDBC without the tax consequences. And so anyway, let's look here. And that's what they're saying here. Buy and hold investors, PDBC, more advantageous, no K1, lower expense ratio. You need to be careful about how you hold it. Best suited for tax-advantaged accounts like a 401k, an IRA, etc. And then the author of this article is saying, trade short-term in a taxable account, I'd prefer DBC. Yeah. Buy and hold long-term in a tax-advantaged account like 401k, I'd pick PDBC. So let's look briefly. This is DBC, and basically it mirrors it's the same mix of commodities, and it appears to be pretty much the same weighting of those commodities. So, basically half is energy, a quarter is food, and then the other quarter is split between base metals and precious metals. So basically, it's an identical exposure to the commodities without some of the tax consequences. So now let's look at the charts. This is PDBC daily time frame. We'll see in the weekly and monthly charts, there's a big open gap in this vehicle, and so that's this gray overhead area here. It's a large open gap. And so we're pushing up into that as a resistance zone, it appears. Notice how, price stopped there and now is dealing with it as resistance, or appears to be dealing with it as resistance. This is the accumulation distribution indicator, and what it shows us is whether investors are accumulating or distributing, divesting themselves of the particular vehicle we're looking at. And so in this case, we can see that investors are holding, and perhaps in recent weeks, actually accumulating, adding to their positions in this particular ETF. MACD is mostly in bull mode, suggesting that the primary trend is to the upside. Currently on a buy signal, energy is elevated. If we look at, I meant to draw this in. If we look at, basically we've got bottoming action down in this area, and then a technical uptrend. We've got a high, a low, a higher high. Well, that's not a higher low. So that we'd have to ignore this action here to say that it's in a technical uptrend, but we could still make that argument that it is in a technical uptrend. Maybe we could also look at this as sideways consolidation. But so anyway, not bad looking in the daily time frame. Again, I would go mostly by the accumulation distribution. Investors are accumulating this vehicle. We had a big washout recently. That was in October. My guess, and I'm just off the top of my head, this probably corresponds to the drop in energy prices, oil in particular. And notice that we got a lot of selling. So the weak hands, capitulation would be one way to look at that. It's basically we washed out the weak hands, and now we've got a new uptrend coming in potentially. So let's keep rolling. Same vehicle in the weekly time frame. Again, pushing up into here, we can see this. We've got a large open gap. One of the things in financial vehicles, and it doesn't much matter what they are, open gaps tend to get filled, and so it's reasonable to think that we will see that open gap get filled, which gives us a target up at $16 to fill that gap, and so that would be one of the upside targets I would be looking at in this vehicle currently is $16. Note that we've got bullish alignment of the moving averages, 10-week averages above the 40-week. Let's see, volume looks okay. Again, accumulation, distribution, investors are accumulating this vehicle, and I suspect that some of this is, being long commodities, having exposure to the commodities right now, is not a bad strategy because of inflation and potential for conflict, war, and then also diversification. And so because of the turmoil in financial markets in general over the last year or so, I suspect some investors have been diversifying their exposure to stocks and bonds, and so moving into commodities. And so this might be an ETF that you would choose if you were looking for exposure to commodities. MACD in bull mode on a buy signal. So again, primary trend is to the upside. Energy is elevated. Notice that we've got bottoming again in the weekly time frame. We've got this low back early 22, and then this recent bottoming touched that level and appears to be moving upwards from that level. So not bad looking in the month or weekly time frame. This is the same vehicle in monthly time frame, pushing up into that open gap region as resistance. Accumulation distribution looks like we got investors divested themselves back in 21, mid 21, and we haven't gotten back to that level yet. So MACD in bear mode in this time frame, suggesting that the primary trend is to the downside. And of course, in this time frame, our Andrews pitchfork is downward sloping, which is suggestive of a downtrend as well. But notice that price has well, let's start back here. So we came down from this high, we touched the median line of this shift pitchfork, bounced, and then we zoomed through the median line and then tested it from below as resistance. That test failed, and so price basically bounced along the underside of the median line for, what is that, 6-7 months before breaking out and moving higher. But the fact that it has broken out and moved higher suggests that we are now back targeting the upside of this shift pitchfork, which would be, $17 a share or something like that. So anyway, although MACD is in bear mode, this chart doesn't look horrible. Energy just below mid-range. And so anyway, based on the three time frames there, there's nothing, there's no real reason to run away from this ETF. Overall looks pretty good. And again, from a buy and hold perspective, part of the conversation has to be is like, well, where are you going to put your money? Is this vehicle any worse than anywhere else that you would put your tax advantaged money? And so, that's a separate conversation, but anyway, it is a relevant conversation when we're talking about tax advantaged savings. So this is the DBC. And so if you wanted to have the same exposure to commodities, the same commodities and the same weighting towards those commodities, DBC would be an ETF to look at. And basically it's a mirror. What it looks like to me is that this mirrors PDBC without the tax consequences. And so just looking at the weekly time frame, again, investors appear to be accumulating or at least holding steady. They're not divesting themselves of this vehicle. MACD is in bull mode on a buy signal. Energy is elevated. So in the weekly time frame, this ETF looks pretty good. And so anyway, that's all I've got. Just wanted to take a look at this ETF. I was asked to look at it. And again, glad that I did. It's an interesting vehicle. As I've said, given my current expectations going forward, having this kind of exposure to the commodities is not a bad way to be invested. Let me say my caveats again. Check with your investment advisor, your financial advisor, your tax preparer, your wife, your kids, your dog, etc. And I will talk to you soon. Enjoy the rest of your weekend, folks.